Hello, we did Molson Coors Beverage Company for our Fundamentals of Finance project. I'm Harrison Mitchell. I'm going to be covering our introduction analysis and our corporate governance side.
And I'm Garrett Thies. I'm going to be covering the risk and return side.
So, for our introduction analysis of Molson Coors, through effective operation, Molson Coors Beverage Company has been able to thrive and grow since they were founded in 2005, mostly because of the merge between Molson Brewing in Canada and Coors in the United States. Since then, they've expanded and acquired multiple companies, with their biggest one being Miller Brewing, which they acquired for 12 billion US dollars, which also placed them as the third largest brewer. So they have a very diverse portfolio, and with this comes with brands like Miller, Coors, Blue Moon, and others. This helps them expand their reach, so it's overall an advantage. Another great component of Molson is their non-alcoholic products. This kind of same with expanding their reach, kind of helps them reach a new market for people who don't support the alcohol side of it, but still enjoy beer. Um, yeah, and then for their distributions, so they distribute from almost every craft brewery and bar that you go to. So aside from just like liquor stores and gas stations, other places that you would buy liquor from, you can actually get these at very various locations. Throughout time, Molson Coors has aimed to meet like consumer preferences. These range from a lot of things, including packaging, the way a can looks, feels, and functions, to sustainability and the sense of reduction of material being used and how environmentally friendly like they can operate and produce their products. So while Molson Coors is big, they're not the only ones. They're competing with a bunch of industry giants. A couple of those are Anheuser, Busch, and they're typically recognized for their Bud Light, Michelob, Corona, Busch, Budweiser, and others. And then they're also competing with Heineken, which is known for Heineken, obviously, Tecate, and Dos Equis, and more. So there are some challenges to this. Obviously, if business is good, their momentum is good too. But being in such a competitive market where they have to rely on momentum means that if they fall behind or anything happens, they can see results of losses drastically, uh, pretty instantly in their market shares and their profitability. So, as far as the management goes for Molson Coors, they've been quite effective and responsive to their shareholders. They work on a compensation based, like on performance. So this kind of helps people realize that, like, the people who are working there, they're being compensated fairly in certain cases. They have had discrepancies with wage pays and stuff in the past, but overall, they do pay on performance. Another great thing, amount of public data and inclusion into their performance and financial statistics from an investor and a consumer's perspective. It's very optimal and it's up to date and it's great for shareholders. Um, Kind of tying back into that, this trait of like transparent communication is kind of a must, especially for them, and can really make or break whether someone is deciding to invest or buy stocks in Molson Coors. Uh, so like through this, with their communication, they often do roadshows, conferences, which all these kind of elaborate their data, future plans, changes, and they talk about other important investor information. Um, and then the ownership of Molson Coors is generally dispersed, and there's not a single entity controlling it. Uh, that is a bit of a hard claim to make. It's slightly false because the way they work is on a dual class share structure, which this pretty much means that you have two classes, and in the first class, which is the majority, will be your uh, biggest people. So Molson, Coors, or Molson and Coors, those are going to be Class A. They hold over 55% of the voting shares. And then class B, which is the minority, is going to be your general public and institutions. So the general public and other people have a little bit less say of what happens. This can lead to problems, but it hasn't really affected anything that much. Um, but uh, and then in the sense of their corporate social responsibility, uh, it's probably one of their biggest selling points that Molson Coors holds, and they advocate and emphasize their professional practice and duty to advertise and target audiences that can actually legally drink. So this kind of helps them kind of determine that they are marketing to a legal and ethical group, and also helps them discourage poor behaviors related to alcohol consumption. So they have a lot of campaigns on responsible drinking, alcohol responsibility, and also drunk driving prevention. Probably one of the most interesting key points about all these campaigns is they're fully self regulated, which means that if something is being put out there for advertisement or it's written, it is fully up to Molson, of course, so they are fully held responsible for it. And then, as mentioned earlier, Molson has committed to being a sustainable company regarding the production of their products, along with the packaging and what they give back to the world and how they're trying to help. Um, some of the backlash that we see with this typically stems off of their marketing practices, such as selling the idea of alcohol consumption rather than the beer itself. So they've had a lot of problems in the past with kind of emphasizing and tying the actual idea of consuming alcohol to things that don't really align with the actual beer. So instead of marketing the taste and everything in the past for ads that have been removed, they have tried tying it to working remotely, hanging out with friends, going to the mountains. They're all great ideas, but it's just not ethical to tie alcohol consumption to some of these activities, so they have faced some scrutiny in the past for it.
All right. So moving on to the risk and return aspect of this analysis, there are some key assumptions that we need to establish before we actually measure the risk and return. So the first one is that all quantifiable values were analyzed over a 1 year period. That's between the starting price on May 1st, 2023 and the ending price on May 1st, 2024. What would have been the risk and or reward to you if you invested a year ago? The only exception to this assumption is that the graphs that are going to be presented did not have data available on the date beginning of May 1st, 2023. They did have May 2nd, so uh, that's the data that had to be used. It's a 1 day difference, but other than that, the second the second assumption is that the risk-free rate is going to equal the 1 year Treasury yield adjusted for inflation. That rate is 4.86%. The reason why we're using that is because even though there are no actual risk-free investments, treasury bonds are typically considered the safest and ride close to 0% risk at times because they are backed by the federal government. The third assumption is that we're going to be using the S&P 500 and the S&P 500 food and beverage industry for comparison. That means that we're going to be using it for our market rate in our kappa model. Uh, and then moving on to total risk and the component distributions. First off, we measured total risk in the state by measuring the historical standard deviation. We got this by taking the by getting the data from a number of different sources and compiling it to get the mean, the variance, and then eventually the standard deviation. It's 1.35%. That just means that 95% of the time, the share value remains between negative 2.74 and 2.66 of the starting value over this time period. Not extremely risky. 5% of the time, it will deviate below or above that range. Now, moving on to the components of this total risk, the market risk or the non-diversifiable risk, is the risk associated to a firm by uncontrollable factors. So things like inflation, things like interest rates, supply chain issues, emerging AI technologies. The measure for this risk that we used was the beta, which was 0.53. Now, what that measures is the volatility of our stock in comparison to the S&P 500, which we represent as a beta of 1. Now, because this beta is less than 1, it is generally considered less volatile. It moves slower and longer over time, and uh, less likely to hike or to plunge. Now, the second thing that we measured was the expected rate of return. We calculated that as 7.85%. Now, how we got that number was by, first of all, the two assumptions of the risk-free rate of return 4.86 and the S&P 500's market rate of 10.5%. Now, the 10.5% figure we got by f- uh, finding the long run average rate of return of the S&P 500. We would have preferred to use historical forecast data, but we couldn't find any that was reliable and within a certain degree of uh, variation. Now, the risk premium represents the extra rate of return that risk averse investors want to have in addition to the risk free rate. That's how much additional risk they're taking on as a representation of what they want to get out of it. Computing all of this together, you get the expected rate of return, 7.85%, which just simply means exactly what it sounds like. It's the expected rate of return that you get from this stock. Uh, the supply chain issues regarding this company involve the fact that Ukraine and Russia are in a war. Ukraine is a very heavily agricultural economy, or at least was, and therefore they supply a lot of brewing companies, including Molson Coors, with wheat, barley, yeast. And ever since this war started, they've had issues keeping the supply chain unfragmented. The other main market risk is emerging AI technologies evolving competitiveness. Now, this is both a blessing and a curse for Molson Coors because they can increase their efficiency in their production, but they also have to be able to compete with bigger companies such as Anheuser-Busch, as I mentioned earlier. The diversifiable risk is less quantifiable than the market risk. It's the risk that can be reduced or eliminated by diversifying your portfolio. Now, if a portfolio has a beta of 1 and you add this stock to it, it will reduce the beta by a little less than 50%, uh, contributing to the uh, diversification and thus the risk reduction of the portfolio. Now, some sources of firm specific risk that we are worried about for this company are: one, there's a labor strike in Fort Worth. Molson Coors is currently conflicting with for alleged unlivable wages. The second one is the recent discovery of quality issues in keg products in Colorado Springs. Now, this isn't. Now, these are both issues because they, one, upset production, they disturb production, and two, they they muddy not just the name of the company, but they also disturb the efficiency of the delivery of goods. Now, getting onto the meat and potatoes of this, we measured the actual return on a 1 year daily basis. So, uh, what's the percent change every single day? Now, should you have invested? The actual return suggests no alone. If you're just looking at this figure, you would say no. It experienced a 4% decrease over the course of the year. Including dividends, it reduced the loss to negative 1.21%, but it really doesn't make the investment any more attractive at all. It's no surprise that this stock underperformed the market and the industry, uh, with S&P 500 escalating to 20.44% of its value from May 1st, 2023, and food and beverage sector rising by 35.24%. There's a specific reason why this stock has a low value, though. If you would pulled out just 2 days earlier, you would have been positive. The reason why the stock is not positive is because right after Q1 quarterly results came out, Molson Coors in their quarterly uh, report stated that even though they beat market expectations significantly, they still remain cautionary about the brewing industry's outlook for the year. They are worried that it's not going to be this fruitful over the course of the year. As a result, shareholders, in my opinion, overreacted by dropping the stock value by 9.01% on the morning of April 30th. You'll see this in the charts on the next slide. Starting with this first chart, it's the percentage change in the market, the industry, and stock returns over the course of the year. So the darkest line represents the Molson Coors closing price. The middle blue line represents the food and beverage industry, represented by the S&P 500, and then the S&P 500 is represented by the turquoise line. Now you can see that there's uh, some pattern of significance between them. Not a whole lot, though. S&P 500 obviously rose significantly over both of these industries. But what I want you to turn your attention to, and this is on both of the graphs here, is the quarter one report line on the far right side. There's a large dip in the stock that represents that 9% decrease, all in the course of one day, which is why I say, had you invested a year earlier, or if you had sold a few days earlier, you would have been sitting pretty. Now, on the right side, you see the 1 year daily return market and stock. And I think this is important because it shows that even though there is some volatility to uh, the market price of this stock in relation to the S&P 500, it's not a whole lot. It's pretty in line with what's going on with the S&P 500. And you also see the same thing here. There is a much larger dip because the stock is a little bit smaller. Now, the cost of capital is the minimum return that would be acceptable to accept a project, whether that's by financing for issuing new shares or taking on new debt. The current cost of equity is that minimum return for or necessary for both an investor and the company to issue equity. The risk premium from the perspective of the investor uh, is that once again that expected return, or not that expected return, that minimum required rate of return after the risk-free rate. The equity weight here is 50.83%. The current cost of debt, on the other hand, was 6.8% before tax, and after you include the effective tax rate of 21%, it lowers to 4.8%. The debt ratio was 49.06%, which implies that it's lower than 50% of assets, suggesting a lower debt risk. Both of these are decent equity weights and debt weights, and um, measures of risk. They're not very risky at all. Now, what does this mean for the weighted average cost of capital? The weighted average cost of capital for this firm is 6.35%, suggesting that in the event that they need to finance, Molson Coors should be able to issue new stock or take on additional debt at this relatively cheap cost.
So overall, when we take a step back from looking at statistics, Molson Coors does a great job at presenting themselves as a respectable and reliable brand to invest in. They do a great job of hitting the key targets of the responsibility to discourage drunk driving and for their responsibility as a company to advertise to individuals who can legally consume alcohol. They do a great job in the sense of inclusivity with their investors and consumers by giving actual up-to-date data and providing optimal statistics where investors can basically view their performance uh, data and kind of understand what's happening in the company when they're not involved in it fully. So they do a great job at actually presenting themselves, and that the sustainability part and all the futures of like kind of more driving towards meeting the consumers' preferences is a key selling point for them for sure.
So, overall, the risk and return on this investment, the risk isn't too great. Uh, it's a little bit risky depending on where you're looking at it. There's the it's despite the recent stock plummet, it does remain a relatively safer than average investment. It's got a lower than average volatility and a manageable cost of capital. However, there are issues with the firm specific risk regarding the Fort Worth and the Fort Worth labor strike and the quality control issue. Um, they could significantly reduce productivity, which could reduce profits and thus reduce shareholder value if both conflicts aren't resolved within a reasonable period of time. Now, these are all things that you should consider when investing in this stock. Right now, you would probably actually want to invest in it, um, like at this moment, because it's currently rising. But keep in mind that these are very active issues going on within the firm. All right. Thank you.
Thank you very much for listening.